All right, we are going to get started with this session. Good evening or good afternoon, depending on where you are. I'm glad you're able to join this evening as we talk about accessing capital as a small business. Just a little bit of background about myself. So my name is Hunter Beck. I am a loan officer for Greenwood Archer Capital. Greenwood Archer Capital is a CDFI, which I'll talk about a little bit later about what a CDFI is. But we are a CDFI lending institution located in Chicago. We provide small business loans to businesses in the Chicagoland area, both startup and existing businesses, and working with predominantly Black-owned businesses in the city of Chicago. Greenwood and Archer was actually the intersection in Tulsa where the commercial corridor known as Black Wall Street was started. And our organization chose that name in order to pay homage to the Black Wall Street corridor, as well as we continue to grow and fund businesses. We're hoping to create more self-sustaining neighborhoods, as well as reverse the impacts of institutional racism through lending. So that's a little bit of background. I've been lending for about 3 years now. Worked with quite a few small businesses, deployed over $2 million worth of loans, as well as grants and other types of capital as well. So I'll talk about those different pieces throughout this presentation. So I'm going to start with 3 main points today and then open it up to any questions that people might have. But the 3 points I want to discuss today for small businesses is the types of capital that are available, the types of lenders and the different lending institutions that are out there and available, and then what lenders look for as you're approaching a lender for capital for your small business. If there's any questions along the way, feel free to put them in the chat, and I'd be happy to answer those. So there's 3 main types of of capital for entrepreneurs that are available. We work, again, a lot with startup businesses as well as existing, but there's also a 4th caveat, which I'll share with you as well. But the 3 types of capital for entrepreneurs are term debt, lines of credit, and equity investment. Then the 4th one is called an EQ2, and I'll talk about that in a couple minutes of what that is. So the first form of capital is called term debt. So term debt is what you would think of when you have a auto loan or a home mortgage. That term debt is a lump sum of cash infused into the business that has regular monthly payments of the same amount over and over until the loan is paid off. Usually they come with a fixed interest rate, but sometimes you'll have what are called balloon mortgages or balloon debts, where it's a certain interest rate for a little while and then grows at a later point in time. Usually there's specific terms set with this type of debt. And this is something, if you have a business that's looking for capital that's going to provide a return on investment for a long time period, this is what you want term debt for. So in order to be a little more clear, I'll say, let's say that you are running a factory and you make socks and you need sewing machines. You would want to fund your sewing machines with term debt. This is a piece of equipment that's going to have a long shelf life, that's going to be producing your product for a long time. So if you have, let's say, a sewing machine that costs $10,000, you might get a 36-month loan for this sewing machine, and you're paying back that $10,000 over 3 years. The goal is hopefully that sewing machine lasts for longer than that 3 years, and it's going to continue making money past that point of when you're done paying it off. So it's a good form of debt because it's allowing you to get the item that's helping you to grow your business, but also that item is going to be around longer than that debt is out. The second one is called a line of credit. This is something when you think about a credit card, or you're thinking about more of a home equity line of credit, or those types of facilities that you see. So with a line of credit, these are more to fund short-term needs. So with a line of credit, let's say you are in a construction industry and you have a project that starts on the 1st of the month, and then you don't get paid out for 30 days. you have to front that upfront capital in order to buy your supplies, to pay your employees, to pay if you are union, have any of those union dues and bonds. You have to front that capital until that money is paid out when the job is complete on the back end, or whenever there's payout cycles. So with a line of credit, what you want to do is take on that debt and you borrow from the line of credit, you pay interest during that time, and then when you receive your payment from the contract that you fulfilled, you pay down that line of credit again, and then you revolve it over and over and over again as you take on new jobs. A lot of times people will think they want term debt for a line of, or when they need a line of credit. Term debt is usually the most known form when you're seeking different types of capital, but a lot of times, if let's say you're in the construction industry, if you get a term debt that is a $50,000 loan over 5 years, you might finish that job in 5 months. So now you have 55 months where you're paying off that debt that you took on to complete or to pay for a job that you've already completed. Versus a line of credit is more of a short-term facility, which will again allow you to draw and pay off and draw and pay off over and over and over as you take on new jobs. The third is an equity investment. So I believe this was talked about during the main stage opening session. So with an equity investment, you are taking on debt that does not need to be repaid right away, but you oftentimes are giving up ownership for that. So with that, I wanted to bring up that fourth little caveat, which is called an EQ2. So what an EQ2 is a form of debt in a that's usually done by CDFIs, which I'll talk about on the next slide. But with an EQ2, it is a equity function, so it has flexible repayment terms. So maybe you take out $20,000, but you don't have to pay back for the first 2 years. And then after year 2, that's when you start making payment. It allows your business to grow. It allows you to use that money however you need to without having to worry about a monthly payment. And then eventually you are paying back that debt similar to a term debt. But it gives a little bit more flexibility. There's only a few lenders, and there's very specific lenders that do EQ2s, but especially for startups, it can be difficult to get that equity investment, and an EQ2 is something that can mirror that. That might give you a little bit more flexibility. At the bottom, I want you to know what type of capital works best for your type of business. If you're confused about the different types, I'd be happy to talk about what those are, or you can talk to your lender that you have. And it's just very important to know that you're getting the right debt facility for your business and the specific things that you're looking for. Now, the next thing I wanted to talk about is types of lenders. So the most well-known type of lender is your traditional lender, which would be a bank. So with a bank, oftentimes you need to show at least 2 years of revenue with your business. You have credit score minimums, and you often have to come with an equity portion, potentially, depending on the type of debt that you're trying to take on. So with banks, they oftentimes offer the best rates of what you're going to be able to borrow the money at. So if you have great credit and you have high revenues and you're making a profit year over year, oftentimes you can go to a bank and get something close to prime, which is going to be really the lowest debt that you're going to be able to borrow at. When I say cost of debt, I mean interest rate that you're talking about. So if you get an interest rate at 3.5%, that means for every dollar you borrow, you pay back 3.5 cents on top of that dollar in return. If you get a 60% interest loan, you're going to pay 60 cents on the dollar that you borrow. So with the bank, oftentimes it's the lowest cost debt, but it's also the most difficult to obtain. So to fill that gap, knowing that, there are what are called CDFIs, which is a Community Development Financial Institution. Now, a CDFI was were created to, one, bridge the gap for startups versus existing. It's hard to get funding if you're a startup business. And two, they were created to, again, reverse the impacts of systemic racism in lending. If you're not familiar, redlining was very, very prevalent and still can be a challenge for businesses right now, as there's oftentimes your business will be treated differently in lending institutions, and CDFIs were created to fight that. So what a CDFI oftentimes can do is help a business start at unbankable and then work their way up to becoming bankable. So with a CDFI, sometimes you're going to be paying a little bit higher interest rate, but they're taking on that risk of maybe a startup business or somebody with lower credit score than a bank would have, or maybe someone had filed for a bankruptcy and you have not been able to access capital through a bank. You can go to a CDFI, and they often have different types of lending options, as also more flexible underwriting. If you ever want to find out different CDFIs in your area, you can search CDFIs by state, and there is a list of different CDFIs by that state and often by region. There's another type of lender, so there's supplier lines of credit. So if you're a restaurant and you work with a major supplier called maybe Restaurant Depot or something along those lines, oftentimes they can give you a line of credit where you can get the supplies you need and then have maybe a 15-day or a 30-day turnaround time where you don't have to pay them back for that time, as the product that you're getting is making you money from the restaurant. And then there's another one which people should avoid, which are predatory lenders. So predatory lenders are lenders who will give money at very, very high interest rates and very, very high closing costs, or sometimes have prepayment penalties. So a lot of times what predatory lenders do is when people approach a bank or a CDFI and they've been rejected by both of those, a predatory lender will say, oh yeah, we can give you financing. Oftentimes they don't ask for very much. They don't ask for business plans. They don't ask for bank statements. Maybe they do. Usually it's pay stubs, maybe some bank statements just to see that you're able to make those payments. But on the back end, there's a lot really, really high interest rates. So I've actually seen some loans that have had 66% interest on their loan that they received. So a good rule of thumb for lenders is the more due diligence they do, usually the less expensive the money is. The less background and due diligence and what's called underwriting they do, the more expensive it is, because they're taking on more risk, saying we're willing to take on, maybe you can barely make these payments, but we'll take that on, but you're going to have to pay a higher interest rate. And oftentimes getting into predatory loans will actually sink a business. A lot of business owners think, well, if I don't have capital today, then my business is going to go under. And go seek out a predatory loan, and it floats them for maybe a week, a month, maybe even a half a year or a year. But eventually those payments catch up, and they become so much that it takes away from the business cash flow. So those are some main types of lenders. There's also hard money lenders, which is a different type where you have a very short amount of time to pay. If you miss those deadlines, then the interest rates increase tremendously. So there's all different types of lenders. So as you approach the different types of lenders, preferably being the bank or the CDFI or the supplier line of credit, these are some things that lenders look for. So the first and foremost thing that they look for is cash flow. They want to see whether you have the ability to make your monthly payment on a monthly basis. So in a cash flow, they'll oftentimes take a look at the business income and the business expenses. And if they're doing what's called a global cash flow, they'll also take a look at personal income and personal expenses. So if you are bringing in business, or let's say your business is at a break even, but you have an outside job that's able to cover both personal expenses and a little bit extra, oftentimes that cash flow can be counted into your loan application, and that can qualify you for the amount that you're looking for. So cash flow is going to be a big determinant of not only whether you receive a loan, but also whether how much you're going to qualify for. So cash is king in the business. If you have cash on hand, that's the number one thing that lenders look for. The next thing is the 5 C's of credit. I'm not sure if you've heard of them, but they are character, capacity, collateral, capital, and conditions. So I'll start with conditions. Conditions would be the economic conditions. So these are not necessarily individual conditions, but taking a look at what the economy is doing as a whole. If there's a recession going on, sometimes credit scores are going to be risen by a bank, and when you might have qualified before, you might not qualify anymore because there's an economic recession going on and lenders are becoming more risk averse. The second one I'll talk about is capital, which goes back to the cash flow. So capital is the available cash that you have on hand. Oftentimes, if you're looking for, let's say, debt to complete a build out for your business location, what a lender wants to see is there available cash and reserves? So let's say you have a $100,000 project and you receive a loan for $100,000. What the lender wants to see is there cash available if the project goes over and it has overruns? Is the project going to be able to be completed? Because the worst case scenario for everybody is getting into a project, not having enough money to finish, and then being stuck with a loan payment and no business to generate income. So cash is a big piece. Collateral. So collateral oftentimes comes into play as you get into larger loan amounts. We, Greenwood Archer Capital, started as a microlender. We've since grown out of that label. But we can do unsecured loans up to $20,000. So what unsecured means is you're just taking a lien against a UCC against the general business assets. That would be called that would be considered unsecured. It's not secured by a vehicle. It's not secured by real estate, just the general business assets. As you get higher into higher dollar amounts, a lot of times collateral can help make a deal stronger. So real estate, if you have a piece of property, whether it's residential or commercial, those can be pledged as collateral in a loan, or a vehicle, or a piece of heavy equipment if you're purchasing that. Those types of things can help provide insurance to the lender that if the loan, for whatever reason, hopefully was not able to be repaid, they could collect that and then make up for the losses in that loan. Capacity is another one. So capacity is saying you're coming to the lender asking for a certain amount of money, and the lender analyzing and saying, with that money, are they able to produce what they say they're going to produce? So let's say you wanted to run a factory, like we talked about before, and you want to produce automobiles, but you only have a space that is 1,500 square feet, right? So is there capacity for that? Does the project and the specs behind the project match what you say you're going to do? And do you have the capability to carry that out? The last one, which I personally think is the most important, besides cash is king, is character. So when a lender is underwriting a loan, they are taking a deep dive into the character of the person. That comes from conversations with the lender, that comes from credit report, that comes from maybe you're talking to different references that people have. But as a lender, you really want to get a good feel for the person that is trying to borrow money. So if I'm talking to somebody and they say, yeah, my revenues were $250,000 last year, and then I get their tax returns and their revenues were $100,000 last year, that would be a little bit of a red flag for me because they weren't giving me the entire picture. Now, if there's other things in there that may have come up, maybe they had separate bank accounts, maybe they had other pieces like that, that we take a dive into that. But if it was just giving information that may have been a little bit misleading or making something seem better than it was, that's something we take into consideration. Also, feeling like somebody is holding back information or not giving a whole story can oftentimes jeopardize a deal. I always tell people, if you're talking with me and say, let's say you had a bankruptcy 3 years ago, it's better for me to know that information up front so I can find a workaround for you than to get to the end of the underwriting process, pull the credit report, find the bankruptcy, and then we have a deal. And now we spent 2 weeks, 3 weeks maybe working on this deal, and we aren't able to do it because we didn't find a workaround from the beginning. So being upfront with your lender is a really big part, and just giving the whole situation really can make or break a deal when you're looking for financing. For startups, one of the biggest things we look for is there sufficient income or any recurring outside income. So if you're running a startup and you're looking for financing right away, a lot of times you have to do what we call is a 9 to 5 and you're 5 to 9. Excuse me. So your 9 to 5 oftentimes brings in enough income to cover your living expenses. And then your 5 to 9 is the business that you're starting and is going to be making your supplemental income. Then when that business grows to the point where it can now take on your main income, that's when you switch it over. And then you take on that, then that turns into your 9 to 5. One of the most frustrating things that I see is businesses will come and say, all right, I just quit my job. I'm ready to start my business. And I look at them and I say, you might want to go back and tell your boss you were joking, that it was April Fool's and you didn't really mean it, and you'd like to have your job back, and you're going to start your business on the side during that time. Because what we want to see is, are you able to meet your individual obligations paired with your paired with the new business financing obligations that you're going to have too with your startup company. Now, for existing businesses, what we look at is, what do your existing revenues look like? And why are they the way that they are? So if you've been in business for a year or 2 years and you've grown year over year, that's a great trajectory. We like to see that growth. We like to see your profit margins increasing. And it's showing that people are also buying into your business, and your revenues are showing that. If you are staying stagnant or actually reducing, that for a lender is a question asking, why is it being reduction? Is it because of COVID? That might be a very valid reason. Or is it because people tried your product and your product isn't something that is marketable, and now the market's just responding to it saying, you know what, we aren't really interested in this product from the first place. So those are things that we look for when we're taking a look at the revenues that a business is producing, is what do they look like, and also why are they the way that they are. Now, some other tips, and I want to leave some time for questions after this, is the first tip that I would give is to build a relationship with your lender. Now, that does not mean the lending institution necessarily. That means, do you have a banker or a lender that you can pick up the phone, call, and say, hey, I'm looking to do this with my business, and these are the things that's going to create, this is the revenue that's going to create, this is how it's going to grow my business. Can we talk about it? Having somebody on the phone, or being able to be by an email or by phone, that you can talk about your business with is very important. One of the biggest things that we saw during COVID is individuals that had a relationship with a banker received PPP much faster than they did if they just had a lending institution and just banked with one of the bigger banks that you have a lot of convenience but don't have a face-to-face interaction with. So building that relationship, someone who understands your business, someone who understands your blood, sweat, and tears that you're pouring into your business is very, very important, because they are an advocate on your team. Now, the other is knowing the institution you're banking with. If you are going for convenience only and not trying to build a personal relationship, a lot of times the national banks are a good one. You can get ATMs anywhere you need to go. You can deposit mobily, those types of things. But you might have a you can really grow that relationship depending on the institution that you choose as well. Another tip I have is for startups is creating a business plan with attainable objectives. When you come with a business plan, it's always good to, as a lender, I try and be on the more prudent side. It's always good to create a business plan that might be your worst case scenario. If you have a best case scenario, that's going to work itself out and it's going to be great for you. But the worst case scenario, are you able to weather the storm if your business doesn't go exactly how you're planning it to? Because oftentimes it does not. So being realistic with your numbers and all the expenses that you can have can really set you up in the right path to be able to have a successful business. And the last tip that I have is know your numbers. So when I call somebody up or someone reaches out to me and I say, hey, tell me a little bit about your business, and they say, I'm creating this product, it costs me $2 to make and I'm selling it at $6, and the margins that the store is taking is 10%, and here's my margins, here's my all the different pieces that I have, all the different expenses, my rent, my insurance, all those things, that makes me feel confident you've put time and effort into your business plan and that you know your numbers like the back of your hand. That makes me want to work with you even more because I feel like you've invested into this business and now I want to come alongside you. When people are like, I haven't really thought about it. I think I want to price it at $30, but maybe it'll sell for $60. That shows me that you haven't really put the time and the research into that plan. So knowing your numbers and having that readily available is also a big piece.